Silly point. I'm 6 hours away from being ready to call the investors, but I just haven't pushed the button.
Okay,
so that's my hope from this call, is to just go off and get it done.
All right. So you're principally looking for inspiration on the slide deck. And for that, by the way, I don't know if you've seen the my pitch deck clinic series. So head over, we've just Googled SeedLegals pitch deck clinic, where I gently pick apart a few companies' pitch decks. And if you watch 2 or 3 of those, you'll see it will all become apparent, the story to tease out in a pitch deck. And you'll see your own pitch deck in new eyes, because often people get so immersed in what they're trying to convey that they don't see it from the other person's angle. And what you're trying to do in a pitch deck is you're trying to tell a story over a 3-act structure that explains the problem space in a slide or 2, explains your solution, it shows the market size and traction, and then ends with what you're looking for. And if you're a UK company and you're looking for UK angel investors, then the magic words SEIS and EIS at the end. So take a look at those and you'll see the formula. All right, now, Neal, over to you, and then I'm happy to dive in.
Sure, fine, no problems at all. Welcome everybody. I'll let people in as they join, but we'll get underway because everybody's a little bit pushed for time. Just to let you know, the order, we'll run with Anthony first, then Ryan, and then I'll have a chat about what we're up to with the Exponential Club, introducing investors online to startup companies, and how we tie in with SeedLegals and other companies. We have, and I'll cover that later, but just bear in mind, we have a Practice Your Pitch event, which Anthony runs with us as well, which is coming up on the 7th of this month. Sorry, a minute, a few more people. Which you're welcome to, anybody on this is welcome to join. And again, later on, I'll cover and send out emails to everybody who's attended, inviting them to that. It's a great thing. We have a few companies who actually practice their pitch. You're welcome to join to see what we do, to get an idea of you know, not what the perfect pitch is like, but we've had a few people over the years come on and who've improved, I think, so much, haven't they, Anthony?
Indeed, yes. And I'm particularly delighted at a founder who I won't mention. When she started, she knew a huge amount about her domain and not a great deal about fundraising. And I think has just done her first round, which, you know, we helped her with the SEIS, the pitch deck. She was a frequent visitor here. I don't see her today, which means that she's been successful in a round. So I'm totally delighted.
That's great. All right. So, again, so anybody doesn't know Anthony Rose from SeedLegals, as I say always, you should, especially if you're raising capital as a startup or even a later stage seed round, whatever you might be up to. So without any further ado, I'll stop sharing my screen, and Anthony, the founder of SeedLegals.
All right, so good afternoon, everyone. Fab to see you. We'll do this somewhat interactively, so I'll pause occasionally, and you can always pop questions into the chat. And I try to look at the camera, not the chat. So periodically, Neal may pop in, and we'll pause and do that. So what I want to do is I want to tell you over the next 25 minutes or so. I call it the 10 things to get investment ready, close your next round, value your company, and so on in the middle. So I'm going to turn on screen share. You can use the slider at the side of the screen if you like to make the slide share smaller and the pictures of me bigger, and go into gallery view and play with the Zoom controls to get what you'd like from the presentation. And of course, feel free to leave video on or off as you wish. Okay, so the story starts with a couple of founders or a couple of founders get together, have an idea, and it's a hobby as initially. And then next step is to incorporate your company. So the very first thing is what I call get the cap table right. And the cap table right in the UK means generally making 100 ordinary shares of £1 each or something like that. And it sounds trivial, but the reason I'm mentioning it is just occasionally we see companies on SeedLegals that have made what's called alphabet shares, A shares and B shares and C shares. And this is often comes from their accountant, or they've been following Facebook and Mark Zuckerberg, and they're trying to make these special shares that mean they've got, super voting rights or something. When you get to Facebook size, you can do that. But otherwise, if you do it, you just make yourself uninvestable, because UK investors or anywhere see many, many companies, and the more standard you can make your cap table and investment terms, the easier it is for them to go, oh, that looks great, you've got this, this, and this, I'm in. And when you've seen enough pitch decks or term sheets, it becomes clear that standardization is important. So when you see somebody who's done something to try and give themselves super voting shares, you just put it into the too hard category. And literally 100% of the time we see companies do this, it needs to get undone later, either because investors just hate it, or it turns out even between themselves, the founders run into problems. One founder's got A shares and the other's got B, and then they split up, and now one's got A and B, and it's a mess. So keep things simple. In a few minutes' time, I might get to company governance to show you why making these special share classes probably causes lots of pain and doesn't add a lot of value, because your real rights generally come much later on and in other ways that are slightly unexpected. So you've started your business with, let's say, 100 shares split between the founders. At some point later, you'll do a share split, which you can do in a few minutes on SeedLegals. It's free. The reason you don't start with 1 million shares is in some versions of using Companies House, its interface, it only lets you create shares of a penny each. So unless you want to write a check for £10,000 to the company to buy your own shares, you're probably going to make some like 100 shares for a penny each and then do a share split later. So the next step is now you want to hire people, or at least maybe you don't have money to hire them. You want people to join your team. And if you haven't done a fundraise yet, either the founders, if they're independently wealthy, are busy paying everyone, or your goal is to get people to work for less money and give them equity instead. So here, there's a simple rule of thumb, which is if the shares have got no value yet, then you can freely give shares to your team members. But as soon as the shares have a value, you should be careful to not give them shares, because under the employment-related securities rules, the employee or the person deemed an employee will now have a deemed tax liability, as if you'd given them that amount of shares in cash, and the company may have to pay PAYE and national insurance and so on, as if it had been paid as a salary. So if, let's say, you had found a CTO and you wanted to give them 5% equity, if you do this, weeks or months after incorporation and months from your first funding round, you can happily do that. You would create some more shares, create an SHO1 on Companies House, do a founder agreement on SeedLegals, make sure there's share vesting, because in the same way, you never pay someone their entire annual salary on January the 1st. They need to work during the year to get their money. Likewise, don't just give someone shares, give them shares, but with reverse vesting, which means you'll get your 10 new shares. If you leave anytime in the next 3 years, or whatever it might be, you have to transfer some of them back to the company for a penny each and so on. So if the person leaves, the company gets the shares back. But as you get close to a funding round and you have a term sheet to investors, or even sometimes beforehand, and you should check with your accountant, the shares may be deemed to have a value. And at that point, you want to stop giving shares, at least to employees. You can still do it with contractors because their tax problems are their problems. And instead, you want to give share options and create an option pool. So let me jump quickly to how many shares or options you should give somebody, because this is a real problem. So let's say your CTO, or let's say an advisor. So you've got an advisor who's helping you. They're going to find investors for you. You're going to put them on the pitch deck. They have gravitas, and they're promising to do intros to customers and partners and the works for you. And they want 5% equity. Is that a good or a bad number? Is it 10%? Is it 0.1%? Is it what? How do you know? So what I like to do, I think the trick is equate the percentage to a pound value, and then it becomes much easier. So let's say your company hypothetically has £1 million valuation, and that's what you want to do in your next funding round. And your advisor is asking for 5%. Well, that's £50,000. And if the advice they're going to give is they're going to pitch up to board meetings once a month, so it's a day a month commitment, £50,000 is quite a lot. You can hire yourself a developer full time to build your product instead of this person who's going to pop up a day a month. So the other thing is this £50,000 of equity, is that going to keep them on board for a year, 2 years, forever? So what I would do is two things. Firstly, figure out as an advisor, realistically, how long are they going to be doing this for? It could be a year, could be 2 years. Maybe you only really want them to the end of your first round. So let's say it's a year. So now £50,000 for a year, for a day a month, sounds quite a lot. I would think more like £5,000 sounds about it. But let's say even if you agreed £10,000, then that's great. So £10,000 is 1% equity, and you want them to be around for a year. So you apply your rule, never give people equity for work unless it vests over time, because otherwise you'll give them their shares, and then what if they never talk to you again? So you would create an advisor contract with them that says, I will give you 1% equity, vesting over 1 year. And now it's great. If they leave anytime over the year, if you've given them shares, you get the remaining shares back. You could alternatively have given them share options instead. The options have an advantage to them, which is if the shares have a value, they would have a tax liability because they're a third party, not an employee. It's their problem, but they still have their own tax liability, and you can avoid it by giving them options instead, when they'll only have a tax liability in years to come when they want to exercise the option and buy the share and then sell the share. And on your side, there's a small advantage, is that by having them with options, options don't have voting rights until they're exercised, and they're not a shareholder. So you don't need to have them give them management reports and have them on the cap table and so on. Not a big deal, but it's something to keep in mind. All right, so talking of options, and I'll stop and do a bit of Q&A right after this section. So talking of options, what's the right size option pool to create? So let me quickly explain options. So options is the right to give people shares later on in the future. Now, whenever you want to give people shares, you need to offer preemption rights to everyone else. This means if I want Deborah to give you some shares for free, I can't just give you shares for free because it'll dilute everyone else in the company. So under the UK Companies Act, if you issue more shares, you have to give the right to every other shareholder to buy those shares at the same price to keep their equity level in the company. So if Ryan has 3% equity, and I'm giving you, Deb, 10% of the shares in the company, Ryan would be able to top up his shareholding by buying more shares at the same price they were offered to you. But this won't work at all. If I'm offering you shares at a penny each for doing work, and Ryan's busy buying them, it's no good. We're all going to be at the same position later. So what you need is, what an option pool says is, I pass a shareholder resolution that says everyone agrees to not take up their preemption right, and I can then create this reserved pool that I can freely give people options from. So it's all a bit slightly complicated legally. The good news is we made it like a 3-click option, so you can go in the cap table on SeedLegals and there's an issue shares product or a create option pool product that lets you do this. So the question is, what's the right size option pool? And generally, the answer is we see it's about 10% option pool. So this means that you're creating this reservation that means you can give away up to 10% of the shares in the company to employees and advisors, and you create that right beforehand. But when you create the option pool, its effect is to dilute all the existing shareholders. So what happens is when you do your first funding round, the investors in your first round, they don't want to be diluted after the round. They're giving you £100,000 for 10% or whatever it is. They don't want to go, I've just been diluted down to 9% because you're making an option pool. So in your first funding round, your investors will normally push you to create an option pool called a pre-money option pool that dilutes the existing shareholders rather than them. That means as the founders, it's going to dilute you. And so the bigger the option pool, the more you get diluted. And if you make too big an option pool and the options are unused later on, it ends up going back to everybody. So if you sell your company in 3 years' time and you've made a giant option pool, haven't allocated the options, it's as if the options evaporate, but you've diluted yourself. So you want to don't make too large an option pool. So my thinking is, my recommendation is make an option pool large enough to carry you to the next funding round, but not crazy big. And often American investors will go, yeah, we want a 20% option pool. That's serious dilution. 10% is about right. And to solve this problem, because it's been gnawing at me for a while, we built a provision in SeedLegals, if you do your round on SeedLegals, to say, on a sale of the company, the founders can get back any unallocated options to kind of avoid this gamification. So let me stop screen sharing for a moment and see if there are any questions. And I don't see any questions in the chat, but if anyone has a question, and that's Deborah holding up your hand, so hi.
Yeah, please, anybody just, get involved. Sorry.
All right, so Deborah, questions.
Thank you. Super clear and helpful. Just a question. You haven't found a legal workaround the option pool in the case of a resale so that it goes back to the founders?
Yes.
The unutilized stock option?
That's right. So we have a solution for that, which is when you do your funding round on SeedLegals, we can build a provision in that says it's a one-click, so it's in the deal terms, which then builds into the shareholders agreement that says on a sale of the company, any unallocated options can go back to the founders.
Okay.
So there is it has a little asterisk because will it work? And so it will work. Two things are needed for it to actually happen. Number one is, of course, it's unlikely you sell your company after your first funding round. You're probably going to be doing this for a while. So what you need to do is in later rounds, you need to make sure you preserve the provision, because if a later round, the new shareholders agreement might undo it. The second thing, which is quite interesting and will be a separate talk for one day later, which is when you sell your company, it almost doesn't matter many of the things you've agreed beforehand, because you have a buyer and you're agreeing terms with the buyer. And the buyer might price your company as if it includes the unallocated options, because they actually want to get your team as well, and they want to use your option pool to give options to the team. Or they may not care about the team, they may not care about you. They just want to essentially buy the assets of the company. Who cares about the team? Or they want the customers. So your mileage will vary at any rate later on a sale. The good news is you don't need to worry about this problem too much today, other than, as my business partner reminds me, everything's a negotiation. So when it comes to a sale, sales go either really good sale, in which case everyone's delighted, or it's a fire sale, in which case it's an acqui-hire, or things are not going well, and the investors may not be happy because they may have lost a lot of their investment. But that's either way something to do later. All right. So Keith, hi Keith, question.
Yeah. Hi guys. Yeah, hi Anthony. Really good information. So I've got a question. It's a slight concern, let's just say. What about the other side of the fence? So I'm a SeedLegals customer. Been working through that, starting a fundraise now. When I first joined the platform, obviously I was inducted. Brilliant service from the guys, I've got to say. One of the first things I did when I incorporated the company and the platform is it is a share split, as you mentioned.
Right.
So I worked everything out. Actually gave up 10 million shares as a split based on research and the type of organization and whatnot. What I have done though is go to issue some shares to my 2 co-founders and actually inevitably added more shares.
Yeah.
So what about the potential of having too many shares? Is that a problem? Can you have too many shares?
No.
Okay.
Company's house, the limit is I think 9 digits or something.
Yeah.
So our founder, my co-founder, we've got, I think just after incorporation, 43 million shares. It's
Great.
just fine.
Fine.
The more shares you have, actually, the lower the price per share in your next round. So the more accurately you can match somebody's investment amount. So if you only had 100 shares and your valuation in your next round was £1 million, that's like £10,000 per share. So someone can't invest £5,000. It's 0 or 10.
Indeed, yeah.
But so
Okay.
that's just perfect. More is fine until you hit 100 billion or something, and then it's problems.
I'll sleep well tonight then. Yeah,
okay.
Thank you.
All right. Any question from anyone else? Otherwise, I'll jump on to the next section. All right. Okay. So question from Rahul. Hi, Rahul. When do safe contracts? I tell you what, let me get back to the question about safes in a few minutes' time. All right. So, but great question. All right. So what I'm going to do is go back to my screen sharing. Okay. So so now we get on to you sorted with your cap table. You have done your founder and your team agreements with vesting. And by the way, one important thing is founder agreements. I'll cover that very quickly. So, founders normally think that all these legal documents they're doing are to protect themselves from investors who want to take over and, fire them and run their company. But actually, the biggest problem I see is founders needing to protect themselves from each other. Because the data on SeedLegals, I mean, anecdotally, I don't track the actual thing, seems to suggest about 10% of the time founders split up. And if they don't have founder agreements, the whole thing becomes pistols at dawn. And if they do, it's still acrimonious, but at least there's not a big bun fight. So I think with COVID, we saw, things are a bit more stressed. People are working at home. It's harder on Zoom, whatever. And there seem to be more founders splitting up. And often, if there are more than 3 founders, that increases the likelihood of a split. So what will happen is at SeedLegals, we get a message, my co-founder's leaving, what to do next? And our team, the first question is, do you have a founder agreement with share vesting? And if so, you basically, the point of a legal agreement, it's like a rule book. When things go wrong, you open the manual and see what to do. My TV stopped working, page 37, does the light come on? So my co-founder wants to leave, open their founder agreement, page 4. If you leave in this period, you have to give back some shares or not. But if you don't have a founder agreement, the departing founder goes, great, I own a third or half of the company, and now you can't continue. So make sure that you've got founder agreements to protect the founders, not only or principally from each other, but later on, the investors in your next round will also want to make sure the founders have got such agreements in place to protect them. All right, so now turning to SEIS. So when you go off to talk to investors, investors fall into different categories. So, Deborah, one of the things to keep in mind, and I'll use you as an example. So when you're going to talk to investors, you want to try and figure out for each presentation you're doing, what's driving that investor. And I put them maybe into 4 or 5 or 6 categories, almost facetiously. So category 1 is, I want my SEIS. It's like, do you offer SEIS? Great. What do you do again? I'm in. So the investor is just wanting their tax deduction. The next investor might be the spreadsheet guru. So they're going to look at your business plan, your P&L. They're going to look at the revenue growth and the traction, and they're going to run the numbers to work out the valuation. And basically, it's all numbers driven. The next one might be cause-driven. I want to save the world. You're doing plastics, recycling from the ocean. Everyone knows there may not be a path to profitability, but it's doing good and I want part of it. The next one might be hang out with the cool kids. So I'm an ex-Goldman Sachs guy. I've made my money. I'm getting on in years. Can I invest in some companies and have fun and, you know, hang out with them and go to events and feel part of it and tell my friends? And the next one is what I call the wannabe founder. So that's a sort of similar character who wants to create desperately a startup themselves, but they're not quite ready. But by investing in your company, they can give you their advice. They can basically be a bit like a part-time founder themselves without the risk, but investing in it. That last one, by the way, could be immensely valuable. It could also be a right royal pain in the ass because you just want to be left alone to grow your business. And there they are trying to micromanage, be a backseat driver. So when you go and create your slide deck and when you go and talk to an investor, you might just as a gamification think which of these investors are they, and then play to the things that they're looking for. You know, if it is cause-based, go with that. If they are very much numbers-driven, play on that. So, but one of them is going to be SEIS. And so for those not familiar with it, SEIS means a UK angel investor. Someone investing personally can write off 50% of their investment from this year's tax, all backdated to last year, which many people don't know. If they keep their shares for 3 years, they pay no capital gains tax. And if your company fails, they can write off the rest of their investment. And you can raise £150,000 this way. And afterwards, you can raise 15 million with EIS, which means instead of 50%, they get a 30% write-off. Now, about 80% of all early stage investment from angel investors in the UK, I see, is investors wanting SEIS or EIS. So it fuels the UK startup ecosystem. And investors usually want to know that they will be able to get their SEIS. How do I know your company can do it? So it's not legally required, but going to HMRC and getting advance assurance means you get a slightly poorly drafted piece of paper from HMRC that you can then tell your investors, I've got my advance assurance. So although it's not legally required, it's often the difference between call me when you get your SEIS, advance assurance, or I'm in, send me a term sheet. And therefore, I think it's worth doing beforehand because it again is the difference between I'm in or come back later. And you can do this. HMRC's been making it more difficult with the years because of too many people speculatively applying. So there are two things that you really need to keep in mind. One, you can't apply for SEIS these days unless you can show evidence of some investment already lined up. So HMRC want to see maybe 25% of the amount that you're looking to raise as now intended investment. So, you know, obviously at the time you wanting to do your SEIS, your investor wouldn't have committed because it's usually contingent on you getting your advance assurance. It's a bit of a catch-22, but you need to give name and address and intended investment amount for up to 25%. So let's say you're looking to get £200,000 of SEIS, EIS advance assurance, you would have to show on your application maybe £50,000. These investors don't have to commit to that, but being a HMRC, you know, don't just make up names and addresses and make sure that they are eligible SEIS investors. So don't put your father because HMRC will go, that looks like the same name. Parents or children wouldn't be eligible for SEIS. So you can do that super easy on SeedLegals. And the other thing, by the way, which HMRC is being more difficult on is what's called the risk to capital condition. So risk to capital is they want to make sure SEIS money is used for growth startups, not property or something like that. So you're going to have to do a bit of a write-up. Usually your pitch deck will show it. The write-up might be as simple as see pages 12 to 15 of the pitch deck to show that the money being used won't be used to, for example, buy stock, which will then be resold, because the stock can always be resold. It will be going into development and so on. And we can help you with the answers to that. So we now come to really the last part of the presentation, which is valuing the company and how much to raise. So you've got your cap table, you've got your founding team, you've got your employees, you've given them options, everyone's got employment agreements and so on. Now you want to go to investors. So the first question, of course, once you've sorted your pitch deck, is at some point you get to, what's my valuation? Because if you don't have a valuation, the investor's just going to go, dude, call me when you've sorted that out. So how are you going to pick a valuation? And you've got two problems to solve. Number one, to pick a number, and number two is to justify the number to investors. So how are you going to do it? So there are a few things you can do. Number one is you can read TechCrunch and see companies in a similar space, but then you've got to take a zero off the end of it, because those are crazy American evaluations, which just aren't going to fly in the UK. So that's not really going to work. You can also look at Sifted or UK Tech News or some more local publication, which lists many startup fundraisers, and they're definitely worth a read. But everyone tells you how much they've raised, but no one says the valuation. So that's not very useful. So the next thing is you can go to your accountant and you can say, can you work out a valuation? That is a completely useless thing to do, because your accountant will go, so are you making a profit? And you go, no. Are you making any revenue? And you go, no. Are you losing money? You go, oh, yes. So at the end of the discussion, they're going to tell you, actually, it's not even a going concern and your valuation is probably negative. So that's not going to work. So the difference, by the way, between an accountant's valuation and a valuation for a funding round is profoundly different. So an accountant is valuing the business based on today's cash position, and an investor is investing based on tomorrow's future potential. And these are different, and that's why an accountant isn't useful for a valuation until, you know, Series B or later, where the company is cash generating, and now your valuation is a multiple of annual revenue, for example. So the next technique you can use is you can go, I'm going to model it based on future projections. So you take out Excel and you go, in year one, I'm going to lose £300,000. And in year two, my revenue will be £1 million. In year three will be 5 million. Year six or year three will be, you know, 10 million or whatever it is. And so from that, you work out your revenue potential, your revenue projections, and then you apply a formula, and then you get a valuation from it, which is great, except any astute investor knows it's BS, because they just made up numbers. And so, you know, I've seen companies saying by year 4, I'm going to do £100 million a year in revenue, which is awesome, but statistically unlikely, because it would make you a FTSE 500 company. And if I can't believe those numbers, I'm not going to believe anything else in your slide deck either. So I view, you know, having those numbers as a projection is an important thing, and investors are going to want to see a 3 or sometimes a 5-year business plan. I think a useful formula is you show, you know, after first year where you go from 0 to 1, afterwards maybe like a 3x year-on-year growth. In due course, it tails off to a bit less than that. Initially, it's a bit more than that, so that the investor can use your business plan as a measure of your ambition. So if you show that you're going to be, you know, a FTSE 100 company after year 4, statistically it's unlikely, and you've drunk too much of your own Kool-Aid. If, on the other hand, after year 4, you know, you're showing £1 million a year in revenue and a burn rate or a cash and a spend rate of about that, it's a nice business you've got, you're growing your team, you're paying yourself a salary, but it's not an investable business. It's what's called a hobby business to investors, and there's nothing pejorative about that. It just means it's like investing in a cheese shop. The cheese shop sells more cheese, borrows money from the bank, buys cheese, sells cheese, everyone gets paid, which is great for the team, but no one's going to invest in it. So you want to show the right level of growth. But either way, those growth numbers are good to measure your ambition, but not hugely useful for measuring the company's valuation because they just made up numbers. So what are you going to do? So what we've done on SeedLegals is using data over thousands of funding rounds, we've seen that companies sell a median 15% equity in a funding round. So this means, let's say that you're raising £150,000. This means if your pre-money valuation, which is before the 150K, is £850,000, after the funding round, the valuation will be 850 plus the 150 raise, so £1 million, and the investors will own 150 out of the million. So investors will own 15%. So raising £150,000 at an £850,000 valuation is exactly one of the standard sweet spots for, a first angel round in the UK. So what you want to do is have a look at the amount you want to raise, have a look at your valuation, and if it's seriously off 15%, you might want to think about if, for example, your investors asking for a valuation that means they would own 30% of the business. That's a problem because you'll be diluted. The founders will have less than 50% equity far too soon. On the other hand, if you're raising, £100,000 at a 10 million valuation, either you're just topping up and that's your strategy, or it's indicating you could be raising more, or your valuation is just sky high for the stage of your business. So all of this really, for me, shows that the standard pattern, and here I think this is a useful thing to keep in mind, because your game plan, it seems to me, and indeed mine, is that you might want to have 3 funding rounds such that at the end of the 3rd round, you're now ready to sell the business, or your business is now profitable and you don't need to raise more. And at the end of 3 rounds, if you've diluted 15% each time and made a 10% option pool, the founders will still have more than 50% of the shares. So in your mind, you might be thinking, my game plan for my business goes something like this. Step 1, the founders put £26,000 of their own money into the business based on SeedLegals data, because no one invests on a PowerPoint. You have to build something. So typically the investors are going to want to see something tangible. So step 1, founders are putting money in, bootstrapping themselves. Step 2 is you might raise 50K friends and family at maybe a £500,000 or thereabouts valuation. Next step, you might raise 150K SEIS at an 800K or thereabouts valuation. Next step, you might raise 500K seed round at maybe a £2.5 or £3 million valuation. And next step, you might raise a Series A round at maybe raising £2 million or more, at a £5 to £10 million or more valuation. So you can see the formula seems to be, you're going to do maybe 3 rounds. You don't need to think that far ahead. Each time raising 3 to 5 times the amount of the last round at 3 to 5 times the valuation of the last round, such that after 3 rounds, you may not need to raise more. And here, by the way, I have a spirited discussion with my co-founder, who, even though he's a serial angel investor and an ex-VC, you would think he loves fundraising, but he really hates fundraising. And his goal is how few times can you raise investment so that you turn into a proper business. And whenever you see companies raising insane amounts, it sounds great, it's great for the ego, but actually all that means is they're on this treadmill of raising lots, spending lots, see the cliff approaching as they run out of money and have to do it again. And instead, if you can figure out, I'm going to raise and aim after the 2nd or maybe 3rd round that I never need to raise again, that is perhaps a good thing to aim for. So if you keep that formula in mind, and by the way, it doesn't mean you have to do each of these steps. You might skip some steps. In our first round, we as founders put more than 20K each into the business. We didn't do the bootstrap round. We didn't do the angel round. In our first round, we raised £1 million because we'd funded more ourselves. But, you know, we've been around the block. You may not have the luxury of being able to do that. So one more thing, and then I'll get back to the questions. So in the formula I've just shown, you're going to aim to do a funding round. And on SeedLegals, our goal initially was to help you do a funding round. And now my joke is my goal is to help you not do a funding round. So what does that mean? Doing a funding round means getting all the investors together on the bus to go at one point. So let's say you want to, you know, as founders, what you've done is you've gone, well, how much money do I need to raise? So you take out Excel again and you go, well, I need 2 iOS developers and I need a backend developer. I need a marketing person. I need someone to do the accounts or whatever. I need customer support. There's myself and my co-founders. So that's 8 people. And let's say it's 50K each a year. So that's 400K. I need money for 18 months. That's 600K. So I need to raise and add a bit more buffer, so 800K. So I need to raise 800K. And of course, unless you're going to hugely dilute yourself, that means you should multiply the amount by 5 so that you're giving away or selling 15% equity. So that means £4 million pre-money valuation. But there's a problem. No investor is going to invest on a 4 million valuation for a pre-launch company, or you can have the gift of the gab to get them to do so. So what you probably need to do is you need to raise a lot less than that. You may need to raise 200K. And now, actually another possibility is instead of doing a funding round and waiting to call all these investors together, maybe Deborah, you know, this afternoon you have somebody who comes along going, I love what you're doing. Can I just give you 20K? Now, 20K is too little for a funding round, but that's where Seedfast comes in. So Seedfast is really almost an IOU or a promissory note saying, I will give you 20K and you will give me shares when you do your next funding round at a valuation to be determined in the funding round. And to incentivize me to come in earlier, you'll give me a 10 or 20% discount. So and by the way, what happens, I'll say, if you never do a funding round, well, it's called the long stop date. So if you don't do a funding round within a certain number of months, then my shares will convert at a valuation we agree, let's say £2 million. And this long stop date, if I'm to get SEIS or EIS, has to be no longer than 6 months. So Seedfasts are a great way that an investor can give you money now, in 1s and 2s. You don't need to wait for them all to come together. It's super simple to create. You don't need to create all the shareholders agreements and so on up front. And importantly, you don't even have to agree a valuation now, because the valuation will be decided later when you do your round. So for you, Seedfasts are a win because you can get investment now. You literally didn't need £300,000 in the bank today. You needed like 50K in the bank, so you can start hiring people and spending some money and so on and paying bills so you don't pay it yourself. So Seedfasts are a win-win. So now to get to Rahul's question, which is when you create a Seedfast, which is our brand name for what's called really technically an advanced subscription agreement. It's an agreement which says, I give you money now and I'll get shares later. But the person doesn't appear in the cap table until the Seedfast converts. And because a Seedfast is not a loan, and it's important not to show it in your cap table as a loan, because loans won't qualify for SEIS. So what it is technically, and you may need to explain to your accountants because they may not have come across that from that many of their companies, it's simply an advanced subscription. So it's money on your cap table that's going to turn into shares later. It's not a debt, it's not a loan, and it's not yet shares. It's simply going to be shown as an advanced subscription. So Rahul, if your accountant still wants more information, drop me an email, anthony@seedlegals.com, and I'll point you to our friendly financial director who gets asked that. I pass all that to him because he knows that better than me, the accounting method for that.
Okay.
All
Anthony,
right.
Can I?
Yep.
sorry, I just want to move on because we're running
Yep.
relatively short on time. Any questions? Could they, they're in the chat. Could you perhaps just answer them via the chat for now?
I will pop in the answers in the chat, and then we'll hand over to Ryan.
Correct. Thank you very much indeed.
Sure. Thanks,
Anthony,
everyone.
great as usual. Many, many thanks indeed. I'd now like to introduce Dr. Ryan Mitchell from Forresters, our IP partners. Ryan, are you there? Yes, you are. I'll stop my video and you should be able to share your screen, sir.
Great, thanks, Neil. So I'll just share my screen. Hopefully you should all be able to see a presentation about making your IP investing ready.
Yes, we've got you. Thanks.
Brilliant. So like Neil said, my name's Ryan and I am a UK and European patent attorney. I work for a company called Forresters, and we're primarily a group of patent and trademark attorneys looking to get registered protection for our clients to protect key aspects of their business, but we're also IP advisors. So we regularly advise our clients on the types of IP that they should have in place to protect key aspects of their business, and also IP that is particularly attractive for an investment perspective. So I'm going to talk to you for about 10 minutes or so just on the key aspects of IP and what investors are looking for when looking to invest in startups. So I'm primarily going to focus the talk on three main aspects of IP. So that's patents, trademarks, and designs. It's also important to note that there are other forms of intellectual property out there, such as copyright for example, new aesthetic creations, musical creations as well. That's an unregistered right, so that just exists when you create it. There's also trade secrets, so sort of business know-how, and probably the best example of a trade secret would be something, for example, like the recipe for Coca-Cola, which is a trade secret. And there's also other forms of IP, which I won't touch on today, such as supplementary protection certificates, which are a form of patent term extension, and other things such as plant breeders' rights and database protection rights. So I'm going to talk you through the three main aspects of IP today, with a few case studies to sort of exemplify how they can be useful. And I'm going to kick off with trademarks. So trademarks effectively designate origin. They let people know whether a particular good or service comes from a particular entity. And there are several marks that you can apply to register. For example, your company name, a product name, a slogan, logos, graphics. There's lots of things that you could potentially register as a trademark. One of the important things when you're selecting a mark that you might want to register is that it must be distinctive and also not descriptive of the goods or services that you are providing. So, for example, I'm sure we're all familiar with the McDonald's logo with the famous golden arches. So that's a registered trademark, and you can tell because it's got the encircled R at the bottom of the right arch, and that means that it's a registered trademark. And everybody that visits a McDonald's will know what they're going to get when they enter into the building. They're going to be getting some fast food. But if McDonald's wanted to register the word fast food, for example, that would unlikely be granted a registered trademark status because it is descriptive of what McDonald's are providing. And importantly, trademarks are pretty handy because they can give you indefinite protection. You just have to renew them, and in most countries it's every 10 years by paying a fee within a certain time period. And moving on to another aspect of IP that's often quite overlooked, and this is registered designs. So registered designs protect the appearance of the whole or part of a product. So if an important part of your business is a product and the appearance of the whole or part of that product is important, then this could be a good form of IP for you. It's also a fairly cheap form of IP, and it's quite easy to get granted registered design protection, so you can obtain protection pretty quickly and at low cost. The bar for being granted a registered design is fairly low. Your design has to be novel, which basically just means new, and have this thing called individual character, which just means that the person that is eventually going to be using your product, it forms a different impression on them compared to everything else that is out there for the time being. And protection can last from up to 25 years if you renew your registered design every 5 years. And you can register quite a broad variety of design. So for example, you can get a registered design status for the packaging of your products, the product itself, or just a part of a product, such as composite products and this shoe design that I put here. And also you can get design protection for logos, computer icons, and typographical typefaces. So there's quite a lot of scope for which registered design protection can be applied to. Moving on to patents. So patents are very much a first to file system. So the individual that files a patent first towards a particular invention will be granted patent protection if the requirements are met. Patent protection lasts for up to 20 years if you renew your patent annually. And it's quite difficult to get a patent. So patents are for inventions, so a technical solution to a technical problem. And your invention must be novel. That is, it can't be disclosed anywhere in the world before the date that you file your application. So you'll often hear patent attorneys talk about having to keep your invention secret and not disclosed, because any disclosure which is non-confidential prior to the date you file your patent will be prejudicial to grant of your patent. And your patent also has to be inventive, which essentially means that your invention can't be obvious over everything else that is already out there on the market. And your patent can't be excluded from patentability. So there's certain examples where certain inventions won't be granted patentability. So for example, aesthetic creations, mathematical models, and just mere discoveries, they're usually not patented either because they're not technical, or because they should be being protected via some other IP rights, such as registered designs or copyright. So if you have an invention which is central to your business, it could be quite a good idea to obtain a patent for that. And we have a strategy in place which allows our clients to essentially obtain patent protection in all the markets that are important to them. And this strategy relies on initially filing what we call a priority application, which is the first application to disclose your invention. And that gives you the filing date of your invention. And anything that is publicly available before that filing date will be citable against your patent application. We suggest filing this priority application in the UK, mostly because it's fairly cheap. The official fees associated with filing a patent application at the UK IPO are very reasonable. And you'll also obtain a search report, which is a report of all of the publicly available information that is potentially citable against your patent application fairly quickly, within 3 to 4 months. And so you can then decide whether it's worth pursuing this patent application in the UK and subsequently in other territories. So if you get this search report and it looks pretty promising, it's a good indication that you will be granted a patent. And we then advise filing what's called a PCT application, which is sort of incorrectly termed a worldwide patent application because there's no such thing as a worldwide patent application. But this PCT application does buy you the right to file subsequent applications in territories that might be commercially interesting. And if you file this PCT application within what's called the priority year, so within 12 months of filing your initial application, you can claim the dates of your initial application, which essentially means that any disclosures falling within that 12-month period won't be citable against your subsequent application. And filing a PCT application is quite a good idea because it allows you to, it buys you time essentially. It allows you to determine the territories that are commercially important to you and then to subsequently raise funds to be able to pay for filing national patent applications, which can get quite expensive towards the latter stages. So probably a good way to show you how IP can be important to protecting your brand and any products associated with it. So look at an example. So here we've got what looks like a fairly old model of an iPhone. And it's just showing all the various forms of IP that are surrounding that iPhone and protecting it. So for example, Apple and iPhone have registered trademarks. The appearance of the iPhone will be protected by registered designs. Any sort of software encoding incorporated in the iPhone, which allow the app to run, will be protected by copyright. And any of the technical features will be protected by a whole host of patents. And it's also very likely that Apple have any trade secrets stashed away regarding any development in the iPhone line. So that's all well and good, but what do investors want to see from an IP perspective? And we think that they essentially want to see two things. So the first one being, are you free to operate? Are your commercial activities going to infringe any IP rights that are already out there held by third parties, such as your competitors? And a way that you can establish this is to look at who your main competitors are and their IP portfolios and see what protection they have, if any, and whether this would preclude you from working with any fields or trading under certain names. And the second thing investors want to see is whether you have protected what you're doing. So is your brand name protected? Are any sort of inventions or designs that are crucial to your business, are they protected too? And so it's good to have an IP strategy in place. So to identify the types of IP that you may want to pursue and initiate initial filings to show investors that you have this intellectual property in the pipeline, and you can show them any search reports that you may or may not have, and gauge whether it's likely that you will be granted this this IP. And you can then sort of establish a protected pipeline based on all of that. And it's also important to note that there are tax benefits associated with certain forms of IP. So the patent box is a way of reducing your corporation tax, and is sort of an incentive to provide research and development in the UK. So how can we sort of assist you in this? So we at Forresters, we offer a free 30-minute consultation with you to discuss your business and any assets around that, and whether there's any IP that we might suggest that you may not have thought of and that can help sort of strengthen your portfolio. We offer a fixed price sort of IP audit service for startups, where we will discuss your business with you and identify whether there's any IP within your business that we can obtain, and provide a strategy for obtaining said IP, and kind of gauge a roadmap for achieving grant of that IP, and kind of establish when that may occur. And we can also assist with writing sort of IP sections for any investment pitch documents. And we have fixed prices for filing or for all various IP rights, because it can get fairly expensive towards the end, particularly for a patent perspective. So it's good to sort of know that these costs are going to be capped. And with terms of in freedom to operate, we can also review what your competitors are up to, look to see if there's any IP out there that might prevent you from working within the field. And we have fixed price packages for doing that and reporting that as well. So this is sort of a handful of the members of our team here at Forresters. So myself, Kate and Charlotte are all in our life sciences patent department. We have Andy, who's also a patent attorney in our tech department, and we have Mark and Daniel, who work in our trademarks team. So we're a full service IP firm with specialist services in lots of different areas. And probably just to leave you on a bit of a success story, really. So this is the story of this product called Marksman. So this inventor came in to see us with an idea that he had, and the idea was essentially this tool for marking on walls where a handyman might need to drill. So basically what it is, as you can see in the picture, is you push this device through a hole in the thing that you need to drill, and it puts a chalk mark on the wall, and it essentially avoids the need to use any pencils, which apparently is quite fiddly and complicated. So this was essentially the invention, and we did a little background search to see if there was anything like this on the market for this client, and luckily there wasn't. And then we assisted with filing the UK patent application, which is now granted. And we also subsequently filed a PCT application to obtain patent protection in markets that were commercially viable for our client. We also registered the term marksman as a trademark for our client to trade under. And we also prepared paperwork for Dragon's Den. So this client went on Dragon's Den with this product, pitched it, and happily received offers from all 5 of the dragons. I think he went with Deborah Meaden in the end, but due to that and having the IP in place and obtaining all of these potential investments, he's now stocked in DIY stores across the UK and is doing pretty well. So I think he was fairly happy to have all of that IP in place before he went on Dragon's Den, and that helped secure investment. So that's basically all I wanted to talk to you about today about IP. If you have any questions about IP, feel free to drop them in the chat and I will do my best to answer them. I'll also put my email address on there as well. So if you have any specific queries that you don't feel comfortable putting in the chat, feel free to email me and I can either answer them to myself or put them to a member of our team who will be better suited to do that. Thank you.
Ryan, thanks very much indeed. There is a question in the chat for you.
Okay, let me have a look. Ooh. Do registered designs apply to software? So no, registered designs are purely for products. Software is usually more of a copyright business, but there is some sort of crossover with patents as well. So there might be scope to obtain patent protection for some software if that software has a technical effect. So registered designs is probably a no-go in terms of software, but there is scope for other forms of IP.
Any other questions for Ryan at the moment, or if you want, please put them in the chat. And
if not, feel free to email me and I can.
Yeah, if you can put all your contact details in there, Ryan, that'd be great.
There you go. I've just put my email address in there. Feel free to email me directly.
Lovely. Thanks very much indeed. Right. Thanks to our partners, Anthony from SeedLegals and Ryan from Forresters. For those who don't know me, my name's Neal Davies. I run Exponential events. We've been holding capital raising events in the city since 2017. And we've also been holding events in various parts of the world, Dubai, Asia, where I'm normally based, Thailand, Malaysia, and such like. I often get asked, obviously, from founders, how do I meet potential investors? So to answer that question very simply, is my advice is to initially go out to your social network, your friends and family social network, have a one-page teaser of what you're up to and get it sent out to as many people as possible to generate some interest of what you're doing. Because one of the main reasons that a startup will fail is that there's no market need for the product. And if you can see there, and I don't want to be too negative here, but 42, this is just based on some analysis and CB insights, 42% of startups fail because there's no market need for what they're actually doing. So it's vital that when you start on your journey and you're looking to raise capital, is that you actually get out there, put your investment, your product, your services that you're doing out to people and see what the interest is. Then you're going to need, as we mentioned before, obviously some sort of pitch deck. We recommend with the teaser that you also have a very short pitch deck, which can be used for 5-minute presentations when you're speaking to investors at pitch events, whether they're virtual or physical. And we hold one of those each month. And then you'll have a full investor pitch deck, which will basically be a smart looking version of your business plan, everything included. But don't start bombarding people with that. Start with that's something for serious investors later on when you've had a few meetings and that they're seriously interested in what you're doing. So to recap just quickly here, social networks, people say to me, what about crowdfunding? The issue with crowdfunding for startups is that most crowdfunding sites will require some form of investment committed already. So when they put you on the site, they might say, we want 60% of what you're raising already committed to by your fellow investors, whatever it might be. So that can be a no-no to early stage startups because they won't have raised that money. They're out there trying to raise it. And it's something to be considered, but it's not a be all and end all of capital raising. Neither is VCs. A lot of people say to me, Neal, what about how do I meet VCs? Well, the answer is that it depends on what stage of development and what you're looking for on your investment journey, because most VCs won't be looking at anything under 500,000 with some form of traction. Not saying they won't, but they, you know. So a lot of early stage startups, I think, waste quite a lot of time trying to get hold of VCs, trying to meet them, and it's not really where you want to be. Possibly what we call SCIS and EIS investment funds, which will particularly invest in early stage startups. They're interesting. And also obviously then your angel investors, which through our events, we used to in London, put maybe 100 people in a room, city professionals, high net worth individuals, accountants, solicitors, fund managers, you name it, in front of startups pitching. The advantage there is then the founder can directly interact with the potential investor and then arrange other meetings afterwards. More recently, obviously, we've been holding these virtually, and we will continue to do that as well. Now, I won't get too much on that. We've recently, on the basis of what we've been doing over the years and the contacts we've gathered, for example, just in 2019 alone in the city, we had 2,000 investors come to our events. So we've built up a large database. What we're trying to do now is to consolidate this database and members into a global members club. Exactly what it says on the label, a dedicated global networking investors club with personalized introductions, exceptional member lifestyle experiences and events that we're offering. So we've just set this up. We've got over 400 members already, potential investors. We welcome startup companies. You can come on and join as a basic member for free. And if you go to www, Craig can put this into the chat again, the Exponential.club, you'll see a screen that looks a bit like this in front of you about benefits and such like. If you click on benefits, it outlines all our membership plans for you, and you can join on there. As a basic member, it's free to attend all our virtual events. So again, then if you click on what will be up the top here, the events section, you'll see our forthcoming events. As I say, we run 3 events for startups each month at the moment. We run a workshop like this. We run a practice your pitch workshop once you're a little bit more advanced and you're ready to go out and pitch to investors. And we run an actual virtual pitch event. We've also started going back to physical events initially in the city. We've got a networking event this Friday, but it's a little bit late to apply for that now, but we've got another one. We're holding those the first Friday of every month from 12:30 till 2 in a place called the Revolution, which is on Leadenhall Street, just down the road from the Bank of England. So again, you're welcome to join us at our networking events where you'll meet fund managers, you'll meet high net worth individuals, potential investors, and people looking at investing in startups and early stage investments. So that's in a nutshell what we're up to, and we're doing it, as I say, via the club. You can go on to the website to say register for free. You can upgrade anytime. Initially, you'll get full access to everything on the site. So you'll be able to go in and search current members, what they're interested in, whether they're investors, whether they're startup companies. There's a little mini bio on each person. So I'd encourage everybody who's looking to raise capital to join us as well. That's it for me for now. Craig, do you have anything to say?
Yeah, I just wanted to reiterate that you know, for anyone looking to raise capital, we know it's a long journey, and getting out and getting in front of people is the key to it. Along with the tools that Anthony's spoken about, and also with Forresters there, you know, a lot of the investment rounds that we've ever been involved in, people do want cover. You know, there's other aspects that go alongside that, you know, such as key man insurance that can be important to know that something happens to you as an individual and that person's investment is in place and protected. IP protection is fundamental for anyone you know, looking to splash significant money into your company. They want to know that everything that you guys have put in place is secure. We've gone to the club. I think getting out and getting in front of people and chatting to people like myself and Neal, who's been around the block and private equity and fundraising for such a long time, is key. And just going back to basics post COVID, or for what is the new normal now, and getting to speak to people by people. Ultimately, they have to like you first and foremost, and then look at your business as an opportunity. So that's, you know, all I would like to add, really, Neal.
Okay, great. Thanks very much indeed. As I say, please join us. Doesn't cost you anything to start with. And it's like anything, you get what you pay for, I suppose. But again, we look forward to seeing you at other events. If you want to pitch or practice a pitch event, please apply again online. All our events, as I say, are on our website. And again, thanks very much for attending. I wish you all a good day and hopefully a successful journey on your capital raising journey. Thanks very much indeed. Take care.